Monday was a fairly uneventful day for equities. S&P's finished slightly in the red, the Nasdaq finished slightly in the green, really not a lot going on there. The same cannot be said, however, for bond markets. Monday was a pretty grim day for rates. So if we have a look at TNX here, TNX is the 10-year note yield. It's touching its 200-day moving average and it's had a pretty big rally. If we look at TYX, which is the 30-year note benchmark, that has actually broken through its 200-day moving average. Now, there's a saying that equities are short the straddle on rates, and what that effectively means is that stock prices are vulnerable to changes in interest rates or bond yields that are significant or that happen very quickly. If there's a significant move up or down in rates, yields, that happens quickly, that can spook the market. The equity market performs best when rates are moving stably or predictably. So when rates fall, if they fall very quickly and by a large extent, that can really spook the equity market that a recession is coming along. When interest rates rise rapidly, borrowing costs rise, refinancing costs rise, which can hurt company profits, it can reduce profitability, and it also makes the valuation of equities less attractive, because the discount rate applied to equity valuations has gone up, which means today's valuation gets smaller. Now, another interesting thing to point out here is that this rapid rise in rates started right about here. All right. Now, why is this day significant? Well, that's the 18th of September. That was the date of the Fed's 50 basis point rate cut. So everyone assumes that just because the Fed has cut rates, borrowing is going to get cheaper, financial conditions are going to get looser. Well, 30-year yields have gone from 4% to 4.5% in that time, or since then. Let's just go back to 10-year yields quickly, which is TNX in TradingView. So September the 18th, again, fell on that day there. And since the Fed did their jumbo rate cut, 10-year yields have gone from 3.8 to 4.2. So 30-year mortgage rates have gone up, refinancing costs have gone up, equity valuations are obviously looking less attractive, and this has been feeding into strength in the US dollar as well. If you look at that US dollar chart, that bottomed a little bit later. September the 18th was back here, but you can see it carved out a bottom since that rate cut, and the dollar has rallied ever since. And the dollar is also back above its 200-day moving average as well now. Now, if rates and the dollar continue to press higher here, you could expect that to eventually exert some downward pressure on equities. That's what I got for you today. I hope it helps, and I'll catch you tomorrow.